A lot of beginner traders get shaken out of good trades for one simple reason. They think that a wick broke structure when it actually didn't. So a candlestick might look weak. It might look like a lower low is forming. It feels like the trend has just changed. But if that candle closes back above the level, the structure may still be intact. So in this video, what I'm going to do is I'm going to show you the simple rule that can help you stop misreading fake breaks, avoid getting shaken out of good trades, and just help you read market structure with a lot more clarity and confidence. So it's a really important topic to understand for reading basic market structure, no matter what strategy you are using and no matter what time frame you are trading with. So what we're going to cover is, what wicks and closes actually mean in relation to the candles and market structure, and why and how it applies to this rule that we're going to follow, why a chart can look like a lower low is forming when market structure is actually still intact, and why this matters for things like a break of structure and a change of character. So if you can't read this relationship between the wicks and the candle closes of the price chart and market structure, then you're going to have a harder time identifying when there's a break of structure, so that's trend continuation, or a change of character, so that's a warning sign that maybe the trend is changing. So it's a really important concept. And this actually confuses almost everyone at first. So you might, look at a candlestick and you look to the prior lows and it visually looks like the candle is making a lower low. And we're going to actually jump over and look at a bunch of examples. And what we need to do is slow down and ask ourselves, where does the candle actually close? So let's visually look at some examples, and then we'll get into what the actual rule is that we want to follow. So I've got a few pulled up here on TradingView. This is a monthly chart of coin. And we can see here that in this month of February 2026, we had a low wick all the way down to around $139. And if we put a horizontal line right there, and we put our magnet on, you can see that this blue line is actually below these prior wicks, these prior lows. But in fact, this market structure is still intact and it was not a lower low. And we're going to go over why that is. Another example, NVIDIA here in the April 25 sort of tariffs, when everything went down, we went all the way down to about $86, which is below this wick. However, this is actually not a lower low. It is a higher low, and we can see NVIDIA did well from that area. And then currently, the stock HBAN, we can see right around this area here, we make a low wick right there at $14.90 and 90 cents, which looks like a lower low in terms of this market structure, but we've blasted sort of out of there. And this was actually, in fact, not a lower low. So we want to understand, why did market structure not break here? Why are these not lower lows? And why is there sort of trend continuation? So we need to basically understand the relationship between wicks and candle closes. So the wicks of a candle, right? So if we're looking at this image here, they represent the extreme high point and the extreme low point of the given candle. So these candles might represent 1 week of time. They might represent 1 month. They might represent, 1 hour. So within this candlestick, if we are calling this a weekly candle, during the week, the high point was way up here. The extreme low point was way down here. And because this candle is green, the price opened at the bottom and the price closed at the top. So the buyers won the battle during this timeline. We opened here, we closed higher, more buyers stepped in during this given week or this given hour, and we closed higher. And then a red candle means that the sellers won this particular candle, this time frame that we're looking at here. So we opened the price here, and the extreme high, maybe at the beginning of the week, it wicked up to a high point, but during the week, sellers stepped in and it went all the way down to this low point, and then it closed right here. So during this week or this hour or this month, these sellers won the battle. So wicks show us where price traveled in a given timeline, and the closes show where the battle ended. So when we are looking at market structure, we want to look where the present day candles close in relation to the prior lows of the market structure. So if we jump back over here, and if we just visually put on a path tool here and we look at the market structure, we can see that from this lower area, we make a high and we make a low and we make a high and a low and a high and a low. So if we are discussing this present time candles here, we want to look at where these candles in this low, where do they close in relation to the prior low? So the prior low for this market structure on the monthly is going to be this wick down here. So we can delete that and just zoom into this area. And again, our rule is going to be, where do the present day candles close in relation to the prior lows? So this wick is right here, and we will mark it right there. And again, we want to see where do these candles close in relation to this wick. So this candle wicked all the way down there and it wicked lower. Price went down there during the month. However, the candle closed back up here. So we closed right here, which is higher than this low. We closed higher than that low. So therefore, we didn't make a lower low. And if we look at the next candle here, there's the low. And where does this candle close? It's green, so it closed right there, much higher than this wick. And this present day candle in April, we look like we're going to close back up here. So all of these three candles, they all closed higher than this wick. Therefore, it is a higher low and the market structure is intact. Yes, this candle during the month, we wicked down here, but we closed back up here at around 176, which is higher than the 140 range in this wick. Therefore, it is not a lower low. Market structure is intact, and we continued higher. So if we just look at our other example here, H-band, again, we can see that this cluster of candles, we can see that none of them actually closed below this wick. They came very close, but if we zoom in here and we put our horizontal line on the low point from this area, we can zoom in here and where do these candles close? This one wick below, this one wick below, this one wick below, but all three of them closed above that horizontal line. They closed above this previous low. Therefore, they did not make a lower low. The market structure was not broken, and we can see we've come out of there and we've continued higher. So that is an important concept with market structure. And again, visually, it doesn't look proper, or it looks off when you first sort of look at it. It looks like these candles are below this set of candles, but actually none of them closed the week below the prior low. So that is the rule. That is the rule. We want to identify in the present time where the candles close in relation to prior lows. So that is the main rule that we use. And we can also use this rule for where they close in relation to an uptrend. So if we just jump at a few charts that are happening right now, we can look at Amazon, Google, and Apple. And we can use this rule to see if we are making any breaks of structures potentially to the upside. So if we jump back to our charts here and we look at the present time of Google, and we can see that currently we are the beginning of this week at the time. And we can see in our market structure, we have a high in this area, which is this wick. And if we just take our horizontal line again right here, we can see that presently this wick and this candle is closing above this wick. So the week isn't open. We want to see this Friday where this candle closes for Google. But at the moment, it is above this wick. And what that is from our market structure lessons, this is starting to form a break of structure. So during this week, if Google can close above this wick, that is a good sign of trend continuation. It's a market structure signal that the trend for Google wants to continue higher. Now, if it doesn't close this week above that wick, then maybe it's a sign that we need to retest support lower. So we can see another example, Amazon has broken out, and Amazon last week actually closed above this wick here. So we had, a break of structure to the upside. which is a positive sign. It's a sign of trend continuation because we closed this candle up here above a prior wick. We have a break of structure to the upside. Now, if we look at Apple, for example, Apple, we have not quite done that yet. These candles here, where do they close? This green candle closes right here, and we have a high up here. So we haven't made a break of structure to the upside. We've actually made a lower high, and we formed another lower high here. So this candle right here, we can kind of mark that off, that the high point was here. We actually closed the candle right here, which is nowhere near these highs. So it's a lower high, and we can see that we have a bit of weakness happening this week in the market. So we have lower highs, an indication that Apple's not quite ready to break and make all-time highs. It needs to potentially retest some support before continuing higher. So the same way that we looked at these charts and we identified that this market structure was still intact, and on the high time frame, we don't make any lower lows. H-band as well, we don't make a lower low here, which is a great sign for continuation. You can also look at it on the uptrend and think we'll make a lower high here. We don't close any of these candles below or above these prior highs. So we are not making higher highs. We don't have break of structures and continuations to the upside. So it's important in reading uptrends and breaks of structures to identify where the present day candles close in relation to prior highs. And on the same thing, we want to see where the present day candles close in relation to prior lows to see if market structure is maintained. So why this really matters, apart from those quick explanations, it helps us avoid exiting potentially too early on some fake out. So there might be some volatility during the week or during the month where price wicks down to certain levels. But if we actually close back above those, then market structure is intact and we haven't sold out too early. So for this particular example, in this present day, if we had some stop losses in this area, or, we sold this wick, that would have been a bad time to sell. We would have wanted to wait for these candle closes to confirm where they closed. And we would have noticed that they didn't close below these wicks. The market structure was intact. So we probably don't want to sell in this particular area. It can help also avoid calling reversals too soon. So if we understand how to read this part of market structure and apply this rule, then when we do have a change of character or what looks like a trend change, if we can understand the relationship between the candle closes and prior wicks, we're going to potentially avoid getting faked out by things that are just wicks, liquidity grabs, and so on. We're going to avoid calling a reversal that is potentially not one, depending on where the candles close. And it just helps us identify those breaks of structures and those changes of character much easier. So again, with that Google example, we can be bullish during the week, but we really want to see where this weekly candle closes. If this turns into a wick this week and closes below this one, then maybe it's a sign that we want to be a bit more cautious and that Google is maybe not ready to break out yet. So it's important to know this rule and relate it to things like breaks of structure and reading market structure to understand where we anticipate the price to go. And also in relation to NVIDIA, we can go back in time and we can look at where things really had a change of character for NVIDIA in this October 22 low. So here we can see that we had a break of structure to the downside right here. So we had a BOS. So basically this red candle, we can zoom in and we can see that this red candle closed below this wick. Therefore, that's a break of structure, a trend continuation. We continued going down to this low. And then when we had a change of character, we would mark it off right here. And when this green bullish candle closes above this lower high here, which is associated with this break of structure, that's your official change of character. That's an official sign that the trend has changed. Market structure is now turned bullish. We have some break of structure continuation. And this important candle closing above this previous high that was associated with the last BOS to the downside, that's your indication that the trend is confirmed. And you can add in some other indicators here, or we can wait for some breaks of structure. And that tells us that the trend is changing. And then, NVIDIA went to do something like a 20x. So understanding that important relationship between candle closes and wicks is really important for reading market structure in terms of breaks of structure, knowing when we have a trend continuation, and then knowing when we have a change of character and potentially a good sign to get back into a particular stock. Now, one important other note is that the charts can be messy. We've looked at some examples here. You'll notice there's some wicks, there's some signs of changes, signs of breaks of structure, but then we get, a sell-off by the end of the week and we just get a wick. So market structure is not always super clean, like we see on some diagrams with, perfect triangles up and to the right. The charts have imperfect swings. So just understand that technical analysis, it's not always perfect, but this rule really helps us filter out a lot of noise. And we really want to combine market structure with some other technical tools in order to find confluence that, support is going to hold or resistance is going to continue to get sold off. So just to quickly recap here, this topic, if it's confused you, the simple takeaway is that wicks show the extreme price of a candle, and the candles can be weekly, daily, 4 hours, and so on. The closes show where price finished, and we use the previous wicks as the benchmark level, and then we use the close of the current candle to confirm whether structure held or broke. So we don't want to, call a break just because price wicked through a level. We want to wait and see where that candle closed in relation to that. So knowing this one rule, it can really save you from exiting too early, getting shaken out by weak fake outs or wick fake outs as well, calling reversals too soon, misreading a break of structure or a change of character, and just making also emotional chart decisions. So a lot of people, they may have sold stocks when they look to be quite weak, but the market structure was intact. They got emotional and just sold at the worst possible time. So I hope that you found this useful. Market structure is really important no matter what strategy you are using. If you'd like to learn more about this strategy that we talk about on this channel, the first link in the description, you can come to our free Stock Trading for Beginners group. We do weekly calls every week. And in the classroom, we have a full course that outlines a whole strategy for trading a momentum style. So I would encourage you to check that link out. You can come and join for free, and we can discuss market structure and any other aspects of our strategy. So thanks so much for watching, and we will talk with you in the next video.